Hi, welcome to the CEO Diaries Season 2. We have with us industry veteran Mr. Swarup Mohanty. Swarup has been the Vice Chairman and the CEO for Mirae Asset Management Company. Swarup has seen the journey from Mirae Asset of managing less than 500 crores of AUM to today 2 lakh crore plus of AUMs. This has been a magnificent journey with over 54% of CAGR growth. It is an industry exception. Today we are privileged and delighted to have him on the show, and we will get some insights on how the CEO thinks for the future of Mirae and the future of the asset management in India. Sir, it's been a delight and an honor to have you on the show, and your pearls of wisdom and your inputs about sectors, micros, global, I'm sure is going to add a lot of value to our community at large. Thank you so much for having you.
No, thank you so much for having me. It's an absolute honor to do this with Bajaj. I owe a lot to Bajaj in my career, so to come back and do this is an absolute pleasure.
Firstly, I wanted to ask you, last 5 years have been very, very different. We have been very close to World War III. There are lots of things happening around. There are regional wars happening. There are geopolitical scenarios coming up. Amidst all of this, there is a situation of Trump coming back to power. So how do you see that for India? One is obviously the stance that Trump usually takes, which is a protection stance and which is good for the US. And as far as I am concerned, I feel that usually the mothership is the S&P 500. So if that is taken care of and that is good and that is looking promising, then it is actually beneficial for all. But I would want to have your inputs more with obviously Trump coming into power.
I think the biggest learning that has come for me, and especially after COVID, is not to conclude. When the war started, somebody asked me, and I was in Pune, what is your view? And I said, boss, nobody has the money for a war nowadays, and it's just posturing. Within 15 days, the question was, do you think this is going nuclear? Then you realize that this geopolitical nature of the world is changing, and changing dramatically. When you look at the leaderships across the world, the leadership styles have changed very dramatically. And mostly, I dare say, the country then is following these powerful leadership styles is something which is emerging. When it comes to Trump, I was there in the US when the election results came out.
Oh.
And I've seen it firsthand. Fact is, one unknown has become known. And because of this leadership styles, you mostly know what to expect from these large leaders. And they will aspire to make America greater. We also are aspiring in our own things for Make in India. As I think China wants the whole world to use only Chinese products, and each to is her own, that's how it's going to play out. But the best part of this whole thing is one big unknown has become a known. And that to me is bigger thing than it being in a limbo state. Now you know broadly what can happen. You have to watch out for some tariffs. Suddenly we are near to discussions on interest rate cuts. And then some of those are becoming more predictable as we speak. But when you look at all this and you look at India, India continues in its own journey. The best part of India is we consume most of what we produce, right? We are very self-sufficient in that, and I dare say that in the world there are very few countries which will continue this 6 to 7% growth rate. So our data points are actually very different from the world at this moment. And for the next 8-10 years, they will hold good for whatever underlying reasons the demography is in place. We've started a great journey on manufacturing, which was needed for the country, and our exports in services will continue. We are going to be the largest wealth generating country at an individual level, and all these add up, right, to all of us. I think when you look at the entire industry, and anybody who tracks data points does agree on the fact that it is a good 8-10 years runway for India. So irrespective of what happens in the US or anywhere in the world, and we've been almost near a World War III, so that risk is also unfolded. And it's been going on. I mean, there's a war going on as we speak, right? And that's also become a known, and we got used to living with a war. I firmly believe if there's another COVID, we are much ready for a medical emergency. So we become stronger through this, but always good to watch out for data points. And not to conclude is my basic theory over the last 5-6 years. World is changing. The person who changes faster will survive.
On the manufacturing and the Trump side, just a couple of more pointers. We have been focusing on manufacturing quite a bit. There have been a lot of talks about even semiconductors, and that opportunity being explored by India quite a lot. With the tariff narrations that are coming from the President's office, do you think how will that impact our sector, especially manufacturing also?
See, I have a basic theory on this. When you go, and we come from Seoul as an organization, by virtue of us working in 17 countries, we get a view on our country from most of these countries. There is no denying the fact that the growth of India is now secularly understood by the world. So I don't believe that even if there are any strong measures coming, they will be directed only at us as a country. It will be widespread, and if it's widespread, the world then mitigates that whole thing. There's too much of talk. I'll wait for the data point to unfold before I conclude. But the fact that we remain a big growth story and the potential of ours is there for the world is something which is recognized across. There's no doubt or debate on that. Secondly, when we discuss manufacturing, I think the green shoots are there. We, I think 3 years ago, had very vocal about India being now or never. If we continued in our services over-dependence, we had that much of growth as a country, and I think manufacturing happened at the right time. I would say that if one is looking at a good secular 15-year kind of a journey, sit in a manufacturing kind of a portfolio, and in 15 years, if you don't leave that portfolio, a lot can happen to you.
Wow.
Because see, we have the laborers because of the age gap, the age profile of our country. Our wage bill, our wages are definitely lower to the erstwhile big countries called Vietnam and China. Our wages are in our favor. The government now wants through PLI this to happen, and I think the corporate tax lowering has just set the whole thing
Stays right.
for manufacturing to happen. Yes, capex is a different story. I hope private capex starts in India sooner than we discuss. That's a big question mark. If that happens and some amount of land and labor reforms take place, we have set the tone for what can be a very good run for manufacturing. So on the US, I'll watch their data points, and their posturing and what they will say will be different. I think it'll be different.
That will be different.
But even if it is, it will be for the whole world. I don't think anything will be India specific.
Coming back to Indian micros, government expenditures. So when you talk about the India story, the GDP story, even in the formula, the consumption obviously stands out quite a bit. And we've seen the last 2 decades, whichever country has done well, we see 60 to 70% contribution comes from consumption.
True.
But the rest of the parameters are also equally important. This year, government had identified to spend some amount as expenditures. The first half, they hadn't done it, and we saw, I think, some relationship to the GDP numbers also on those lines, and it had a drop. And then all the estimates, even from the RBI and all, had a revision in their estimates, and it was a downward estimate. How do you see that? Because their fiscal deficit is obviously growing up. This year, obviously last year budget, they said 4.9%. This year, they're saying 4.5%. That I think will be a challenge to achieve. And there are certain other pointers also which could be a concern. So how do you see these macros in the Indian scheme of things?
From a macro perspective, let's look at the country going through an amazingly secular run for 3-4 years post-COVID. When that happens, some amount of slowdown is expected, and that's what happened from an urban perspective. Yes, it was backed by what you rightly said, a slowdown on government capex. And that too, when you look at government capex, was practically one way for 2-3 years. And then post-elections, they would have stepped back and taken their own call. I'm not a person who looks too much into budgets, but this coming budget is something which one has to look at, because one is setting the tone for the next 4-5 years. Very crucial 4-5 years for India. So from a policy and reform perspective, yes, this budget becomes crucial. And that's something which I'll definitely look out for. Because of the urban slowdown, we did see numbers being weak, and some amount of weakness on the corporate results also combined. So when you look at government capex coming down, urban slowdown, and some amount of weakening in results, they all combine to form this broad, what we call a near-term slowdown. But when you project it over a period of time, like I said, this 6 to 7% growth cannot go down is my opinion, and one can back it up with data. Yes, and one has to watch out for reforms through the budget this time is something which I'll watch at. Our house view is, the rural uptake can balance the urban slowdown is something which we feel is round the corner, because a lot has been done for the rural in the last 3-4 years. That result will happen now. So watch out for that, and that could be the balancing factor as we speak. Globally, when you see, we do expect a bit of a China stimulus to enhance that, and once that happens, a lot of the other sides, say we were just discussing the chemical industry just before this discussion, China plays a lot of a huge role in a lot of the other sides. And once that happens, one should watch out for that also. And combine that, one can look at a very different year in 2025 is our house view.
That brings me to a point, on the lines of September. This year, September, we saw globally a lot of federal banks cutting down the rates. We are still facing inflation issues, I think, as per the target of RBI. And do you think RBI, or central bank, doing certain stimulus on the likes of maybe China or something on those lines, or the rate cuts are near the corner so that some stimulus is provided to the economy?
See, I'm too small a man to comment on RBI, but I think when the stimulus during COVID was a talked about factor across the world, we were criticized for not doing that. And today we are standing strong because our coffers were not empty through that. I mean, let's face that big thing that happened in India. At that point of time, everybody was criticizing us. A lot of Indians were so. But today, on hindsight, that was the right decision to take. I don't think, is my opinion, personal opinion, that we are in a situation for stimulus at all. We are a strong country, fundamentally strong at a ground level with quarter on quarter data points from consumption to manufacturing adding up. You can't conclude on just one quarter, right? And that quarter is happening after sustained quarters of growth. So some amount of such slowdowns is good to know where the bottom is. It also helps policymakers to figure out where the bottom is and then what is needed. I think when you project it 4 or 5 years later, you will look back and say maybe that was a good thing to happen. Always is. For even building organizations, sometimes a slowdown is where you really know where your weakness and strengths are, and that would probably reflect well for the policymakers going forward. I think that said, we are definitely near discussions of an interest rate. I don't think we'll be the first one to do it. We'll follow the US Central Bank on that, is my opinion. But yes, I think from that perspective, we are near those discussions, and 2025 should be that year, is my opinion.
Coming back to the markets,
Yep.
there was something that is probably a discussion point. Like 5 months ago, I saw a lot of people being very bullish about the markets. Last 3 months, a lot of people saw some corrections, which they hadn't anticipated. So do you think we are still overvalued, and India as a story is overvalued and oversold?
See, India is always overvalued. Country which sells potential at this level will always remain overvalued. But our house view is it's reasonable. It's not yet cheap. When you look at the markets, the large caps have corrected, mid and small have not corrected. So that's a very interesting position. In my working life, I have not seen this happen. But there was a fair amount of aggressive selling in a certain pocket for that to happen. Yes. So I would attribute more money going out of India than a basic underlying for that. When that kind of money goes back to the US, some amount of impact will happen, and I see that as that impact. But when the markets rally like this, and then when you look at the market has rallied in certain pockets. When we go back 3-4 years ago and do just a basic analysis, what used to be growth stocks now look like value, and what were value stocks look like growth. The market has turned upside down. But in the last 5-6 months, we're seeing that kind of, not yet reversing, but trends now beginning to widen. When markets move in small pockets, the rest of the market opens up for value. And that's that classical situation that you are in. There's a broad segment of the market which is opened up for good value. When you talk to any fund manager, a fund manager will always tell, when you ask them what to buy, their aspiration is to buy a good business at a good price.
Good price, yes.
At this moment, some great businesses, because of this small pocket run-up, some other businesses are available at great prices.
Very nice.
So when you look at equity as an asset class, or buying equity as an asset class, there are times when you get good prices to accumulate on. And when you look at the last 2 years prior to the last, say, 6 months, IT was probably there. And suddenly the US went from an unknown to known, and IT now comes back. Those great companies were available at some fantastic prices. Look at some of our private banks.
Yeah,
Great banks available at great prices. Either you look at the last 3-4 years of underperformance,
All the
or you
time.
wonder because of this great stock underperformance, you are getting that stock at this
At a
value.
very good price.
If you're not buying them now, when do you buy? It's a call you have to take, right? So when that happens, there's a broad part, and this is across market caps. It is not just restricted to large caps. Across market caps, that cliched statement of being a stock picker's market is where it's come back to, and probably it will differentiate good fund managers and great fund managers in the next 1-2 years. It is also a time not to reflect on the past returns, to predict your future returns. That would be the biggest folly, I would say, because the market can change dramatically.
Which is what I wanted to pick your brains on. Like this market we have seen, especially large caps, as you said, there has been some correction on large caps. Mid and small has still shown resilience. I feel that is also to an extent because of the FII flows.
Yep.
There have been a lot of FII outflow from large caps. And large caps predominantly, if we see, as far as market capitalization is concerned, last 15 years, the highest that they had contributed to the market cap was about 77%. Currently, it is about 60%. On an average, I think it should be about 70% over the last 15 years. So there is still, the contribution of large cap towards the overall market valuation is lower compared to the last 15 years average. FII money is also outflown from the large cap. In this situation, when the FII money comes in, don't you think it will come back into the large cap only and makes the large cap more interesting than the small and the mid cap?
I think
why this question, add on, is because we have come up with a small cap NFO, which is what I would want to focus on as well. That, why in this situation you feel there is a huge opportunity in the small?
Okay, let's keep the small cap aside first.
Okay.
It's a very interesting discussion we had internally. We feel the market has become more democratic in the last 4 or 5 years, and that's the best thing that could have happened to Indian markets. I'll look at 2-3 points on this. First, the flows are not restricted to just one segment.
Okay.
If we have large FIs flows going out, there is a corresponding domestic flow now. The democracy there is playing out. Earlier, when you look at listing of companies, and India is in the last quarter one of the largest listing companies, countries of the world now. Most of the listings now are on the mid and small side. The new companies, there are very few large cap listings happening as such. That's also widening the market. When you look at the market caps, what used to be the highest market cap for any stock or category is now completely changed, right? The sizes of those market caps have changed dramatically across large, mid and small. The liquidity of the market, which used to be a concern, always. I mean, when we talked about the markets from a Mir Asset perspective, we always highlighted that Indian equity markets very liquid. But when you look at the last 3-4 years, that's also changed dramatically. So we are finally seeing broadening of the market, what we call the democratization of the market. So the opportunities, and what you said was absolutely right. When you looked at our house view, and if you Googled us, any of us speaking in the last 4 or 5 years, we would blatantly give a large cap biased kind of a view.
Correct.
Based on the size and occupation of them in the market. But when you look at opportunities for the next 10 years, and with the new companies, good companies, listing more on mid and small, that somehow also get democratized. What used to be a blatant 70-30 view is now slowly tending towards a 60-40, can tend towards a 50-50. If it tends towards 50-50, it would augur well for the underlying breadth of the market, something which me as a professional was looking forward from the choice of fund managers perspective. The number of stocks that we would cover is probably doubled because of the listings that are happening, and the next 2 years is about new listing, right? So these are things which need to be taken into consideration very seriously when you look at Indian stock markets. I mean, the necessary pillars are now beginning to fall into place. And make no mistake, from a regulatory perspective, it is a very strongly regulated market. The flow of money is identified. It is very structured market to be investing in. So the investor protection in these markets probably better than many markets that I know. These are things which have happened in the last 4 or 5 years, not earlier, right? So post-COVID, it's a very different market. Now, when it comes to a small cap listing. Every fund house has its journey in fund management infrastructure. If you check our fund listings or fund NFOs as we call them, it's the beginning of a journey. All our funds post NFO have only added money. There is not a single fund which has gone down on its AUM post. The beginning of any fund, forget the small cap, is the starting of the NAV, is how we look at it. And then we build track record. Finally, the mutual fund business is a business of track record. If we build good track record, then we deserve money, is the way we look at it. Now, when you look at pure listings and pure the market being one small part, there are opportunities across market caps. Whether it's large cap, mid cap or small cap. I mean, I am guilty of having called India always being a mid cap story. I'm now converting it into a mid and small story. Not exactly, I'm not giving away mid cap yet because India remains a very strong mid cap space to be in. But because of the new companies being listed, it is tending towards the small in a very serious manner. But when you look at small cap investing, it's a very different way of investing. It's a far longer investment horizon. The last 2 years would have shown a very different picture. But don't get carried away by the last 2 years and come back to the basics is what I would really look at. It's a good, see, any time is a good time to launch a fund. Like I say, any time to buy is when you have the money. What is the right time to buy is when you. So for us, as a fund house, we've always been a fully invested fund house. We like launching funds when the euphoria is not there. All our funds would have been launched when the euphoric segment or when would be gone, and then people would buy on merit. We don't time the markets ever. So we have a good fund management backend. Varun joins us recently, and coming back to the fund management infrastructure story, we would launch a fund when we have the backend in place. Now we have the fund management in place, we have the analysts in place, hence we are launching the fund. And we back our fund management team to pick 50-60 good stocks, and I do believe there are 50-60 good stocks in all market caps to give at this moment.
So while we're talking about the markets and the participation of the markets, a lot has been said about the retail participation. And when we deep dive into it a little bit, we find that most of these were probably investors who had actually not seen the 2008 cycle. In fact, most of them are less than 40 years of age. True. This is coming into place. How do you see that going forward? The demography actually plays a very important, crucial role right now.
I'm not trying to sell a product, but I'll give you an example on this. It's been a learning. We launched what we call the FANG Plus. It's a 10-stock disruptive tech portfolio. And according to me, with my baggage and track record of mutual fund risk selling, it is the riskiest product that I have ever sold. So I freaked out. I said, let's go and discuss all the risks that can happen. 10 stocks, right? And in one of the presentations while I was making, somebody asked me, Swarup, are you asking for money or are you scaring us? Right? It came to that. I was paranoid, right? And the fund launched. It was a retail held fund. Across, in 2 days, on the ETF, we got 10 crores from retail.
Wow.
That freaked me out even more. I mean, this is a risky product now being owned by the retail. What is happening? And then the fund went down 25% absolute. I was dreading it more, that the calls I will get, Swarup, what is happening? And the limits were hit, so the fund was not open for purchase. I got only one call. When are you opening this fund and why are you not allowing us to buy this fund? That was an eye-opener. Nobody was saying that your 100 rupees is 75 rupees now. People were saying, why are you not allowing us to buy at 75 rupees?
To average it.
And that is this demography. When you look at this demography, I feel they are more educated. They are definitely superior risk takers. And they kind of know what they're doing. And I'm not saying, and I'm saying this with all humility, if that fund was open, that size of the fund would have been a different thing altogether, irrespective of the volatility. Even today you check, the fund is closed, please check the trading volumes on a daily basis. We're writing out to people saying that please don't buy at these premiums. But people, we've written out twice, I think, to investors that it is not right to buy at premium. but they seem to be knowing what they are doing. I'm not commenting on that. But the point I'm making is this demography unfolding is both an opportunity, is also a time to reflect for us as a community who's addressing them. I feel personally that the products they will look at may not have any correlation with the products we have.
Oh.
My son, who's 26, will not buy a flexi cap. I am very categorical. I buy it for him, so he buys it. But given his risk profile, he will tend more towards these products. We've launched some EV products which have just been lapped up on a daily basis by that age group. So the products that will be catering to them, I feel, will have to be very different. Otherwise, they will invest elsewhere. It's up to us as an industry, up to us as sellers, up to us as advisors to now graduate to their thought process. That's where is bulk of my thought process when we look at building an asset management company for the next 10 years with that demography unfolding. I dare say some of the products will have to be pushed up the risk profile. It will be a lot of unlearning for guys like me, but we have to do that to understand them better and give them financial solutions catering to their risk profile. Is something which is happening every day as we speak. Some of the ads that we were showcasing have to be revisited. How we approach discussing their financial plan has to be revisited completely, because that's a new India dawning, and it's a good India dawning.
Coming to the multi-asset frame of work, a lot has been happening in the gold, silver, metals area. What has been spoken also. We've seen good systematic rise of gold, silver, even imports have risen quite a bit. Where do you see the multi-asset category?
I think the second biggest learning was the multi-asset category. I mean, guys like me who stood up on various forums, various stages, said equity is the asset class, growth the asset class. You just compare gold versus the index over the last 10 years, we're all wrong, right? and that's where when we discussed return probability at a median level, and that's where the virtue of asset allocation comes in. And today in 2025 as we speak, let's look at it. The investor is spoiled for choice. The markets have become reasonable. Debt today, because of interest rate discussions being very vocal now and almost at a reality level, debt looks very attractive from the next 1-2 year perspective. Because of the volatility of global data and the fragility of global data, gold as a commodity remains attractive. Sovereign buying will continue. So it is the asset allocator who will win in 2025. The market timer will lose very badly. Okay, so that brings this product in a complete focus. I mean, and don't look at it as an asset allocation product. Look at it as a fund construct. Because if you look at it as an asset allocation construct, then the fund's asset allocation becomes your asset allocation, which is fundamentally flawed. But as a product, because it can now take advantage of these three opportunities, and historically also, if you look at sheer data, the ability of that category to give median return is superior to just one asset class. And that's been the biggest learning of the last 3 years, is that the multi-asset is a core product and as a product itself. And because it has this great flexibility to cut across asset classes, yes, fund managers have to manage it well. That's the underlying. But as a product, it's a brilliant product.
It's another pointer which Mirae has been standing out, and I think in our discussions also, in one-to-one discussions, I have noticed that you have been vocal about the passive funds quite a lot, and in fact one of the first ones to introduce quite a bit of passives, including the current EV ETF, which I just saw, and I was like, this is something completely different, and new age consumption and all those kind of ETFs. So where do you see the passive and the active, the comparison that has been going on for a while?
I mean, let's look at the industry, right? And till COVID, we were 2.3 crore folios. Today, we are 5 crore folios, right? So we are adding 70-80 lakh folios per year now. What had taken us 20-25 years to do, we'll start doing in a year or so. Wow. And this new investor is more young than what used to be. So the way they will invest can be very different from the way, say, my father and I invested, right? Now, we feel that investing will form a pyramid. At the bottom will be participation. Okay, that's where the bulk of the investors will come in. And now thankfully I am the manufacturer, so I am not the one to judge. It's your job to judge which is the right portfolio or product for the investor. Our job is to give products and remain neutral across products. That's our job. And have the ability of managing each product well as per the merit of that product. Now, when we look at the future and we see participation happening at a broad end, there will come a large number of investors who will look at the market just to participate. And that's where indexes form a great part. Now, one can look at it as index funds or one can look at it as ETFs. I think post this taxation, the FOFs through ETFs have also become equally attractive. So people will start at the bottom end, and I put the core active funds there also. So the large cap, the flexi caps also there, which will broadly mimic the benchmark. That's where broad money will go in. After some amount of participation, they'll probably say, okay, I need some expertise, and will graduate to riskier products. Might graduate to factors in ETFs also, right? Which gives some excellent options. I mean, to give you rule-based active like solutions is also something which will attract people. And over and above will come those riskiest asset classes in the form of PMS, AIFs, and now the new asset class is also opening up for mutual funds. So that is how the pyramid will form. As a manufacturer, our job is to play a role in all these parts and then cater to all possible investors with all possible risk profiles.
So that brings me to the new age investor. Another area is the option markets. We've seen the maximum account opening in the last 1 month. How do you see the option markets playing out?
It's not about the option market. I think today, going forward, no wealth proposition is complete without a broking proposition. The young will take to broking, and this is not a bull market phenomenon. I mean, the options is something which is a factor of the last 2-3 years. When you look at the markets, money making has become so easy that the temptation has started growing. That will get mitigated. I think the regulator is also involved in that. But if you look at the options market, what is coming out is that people who've been very scientific in their approach and have looked at data in the form of algos and whatever I've heard, is that those are the people who are actually being able to do better. So just brings in the science and the art of the business in a different perspective. There are opportunities everywhere, but if you're going to treat it as gambling, more often than not, you're going to lose. There is a process to that, but I do feel that the revival of stockbroking in India is real. See, we are 5 crore folios, they are 10 crore accounts, right? So people ask us why ETFs. I say we are catering to a larger market. But I think going forward, and that will be a change in the next 8-10 years, is that broking propositions will be serious now going forward.
And brings me to the thought process of Mirae Asset as an asset management company. Now, you've been running this company since the time it was less than 500 crores of AUM, 2 lakh crores. Firstly, congratulations on crossing the 2 lakh crore. It's a milestone in in any aspect. How does it feel, and what has been the learning through this journey?
Learning is very simple. See, I'm being very honest with you. Rarely do you get a chance to do a fiduciary role as a job, and I'm very fortunate to have got that job. I mean, you enjoy the trust of somebody else's hard-earned money. It cannot be a bigger job than that. So the point number one is to always do justice to that, and I dare say on behalf of the entire team, 16 years in this country without any regulatory breach is something which we pride ourselves on. If we can continue that track record for another 10-20 years perpetually, a lot can happen for us, and that is focus number one for us. 2 lakhs is an outcome. If we continue this, the outcomes can be larger. If you concentrate on the outcome, it will never going to happen. So that's our focus on, and that's something which we'll continue building. And yes, to be the only organic global asset manager in India is a differentiator, and that just shows the focus of our promoters in India. We believe this can be the hub for us outside Korea. Unlike many people who go to Hong Kong and Singapore, our focus is in India.
Very nice.
And to work for an organization whose number one focus across the world is on India is also lucky and being fortunate. But it's a great time to do this business in India as the financialization of assets is happening. And this now takes a very different turn. And if we can continue building a good foundation of ourselves across businesses, I think we can. I must tell you, when I joined Mir Asset, I had gone for a meeting with Mr. Rajiv Bajaj.
Okay.
This is 2011.
Okay.
And he had said, Swarup, you know, what is your challenge? Your challenge is to bring the aura of Mir Asset to India. I didn't understand it then. He said, I have seen it in Korea. Can you get that to India? And today, when you reflect on that particular subject, I'm beginning to understand the meaning of it. Yeah, it's a journey that we are taking. But I think we have built a good foundation for ourselves.
Absolutely, absolutely. So there are many congratulations in order actually. And there are many learnings. When I look at this journey, I see that, a salesperson, actually not even a fund management background technically, getting into a CEO role and then taking it to a level with 55% growth year on year, which is very, very good. And plus now we are seeing Mirae as a group, even getting into wealth management and other assets. Like congratulations for taking the acquisition of Sher Khan. Which again was a very, very welcome surprise for all of us. So what is the way forward for Mirae now?
When you look at business models globally, I think this is a very unique model. And as a student of this industry, I followed this model very, very intensely. Typically, people come to mutual funds from other businesses. But for
Either
Mir
a
Asset,
bank or something.
correct. But for Mir Asset, this is the core business. If you look at us in South Korea, we were the first mutual fund house of South Korea. Okay, we started the industry there. Our chairman, Mr. Hyunju Park, started this industry and named the first fund as Hyunju Park #1 fund because he was a star manager and people would know his name and invest. But it is an excellent model of the AMC being the cash cow and this money being utilized to build other businesses.
Other businesses, wow.
That's something which I learned and very unique. So that's something which we've tried to build in India. I mean, please understand that this is a business of annuity. If you can keep the basics right, then the earnings from this industry for the manufacturer can be perpetual. So how do you utilize that surplus to form other businesses is something which I learned from the organization and which is something which we are trying to emulate in India. We've come some distance. Yes, the Sher Khan acquisition is a huge milestone in our journey in India. It's a very serious acquisition. According to the words of our chairman, it's probably one of the most significant acquisitions he's done globally.
It is.
And with where we are positioned in the country on the possibilities of wealth, it's come at a right time. Again, we've done the job, but how we act on it, time will tell. I think we are building for that. And if we can build a good outfit there, completely client-centric, a lot can happen.
Well, we are at that right now, and you've seen such a large journey for the equity markets and overall also. I would want you to share some pearls of wisdom for even our team and the clients in general.
I think this is probably the best time to be in this industry. I mean, my only regret is I am not 10-15 years younger at this moment, because what can happen in the next 10-15 years for all of us as investors, as career people, as people who safeguard somebody else's money. We have no clue on as to the enormity of what can happen. The key number one is to keep your integrity intact. I think that's fundamental, because somebody else's money. If you keep that one intact, a lot can happen. Right. Second, if you are managing somebody else's money, then the process on that is known to all of us. And then if you can grow that money, it's a business of trust. Upholding that trust is sacrosanct to our job. It's a very simple business. If you keep it simple and not complicate it, a lot can happen. I mean, it's a boring business. If you can make it boring tomorrow, and the results can be pretty phenomenal. But make no mistake, this is probably the best time to be in the industry. Back yourself to your potential, and the markets will give its due, and it's the only economy which will double in the next 7-8 years. and we happen to be in
We happen to be at
economy,
the right place.
time. So please make good of these 10 years as we speak, and because then the risks of the country start flowing up, the inflationary risks, the so-called demographic can go the other way also. Before that happens, I aspire to complete all my financial goals in the next 10 years. It's great luck that I'll be retiring then, so I've timed it well. But don't mistake the power of these 10 years.
That's really nice of you, sir. And thank you for having, spending time with us, and thank you for sharing the insights that you had. It's really nice to have you on this CEO Diaries.
Thank you so much for having me. It's an absolute pleasure. Really, it's an honor to be on the show.
Thank you so much.